right, guys. Welcome back to Loan Officer Success Live, sponsored by Premier Lending. We got a special show today. Kentucky just introduced a new path to homeownership, but the first round of funding is limited. So we're going to talk about SAM, what it is, who can use it, and how quickly do Kentucky homebuyers need to act. Today, we're getting all those answers directly from Kentucky Housing and from one of the lenders helping families use the program. So welcome to the show, Jamie Rice, here from Kentucky Housing. And she's going to talk about how it works, what it was built for, and where it could go next. And we've got Brad Chambliss from New Beginnings, a division of Premier Lending. And he's here to show us what SAM could mean for real families trying to purchase a home. Welcome to the show, guys. Great to have you here.
Thank you, Devin.
All right. Sorry, I'm having problems with one of my channels, but that's okay. We're just going to move on and act like it's working. So, Jamie, I'm going to start with you. Before we explain the program, what problem was Kentucky Housing trying to solve with SAM? And let's talk about what SAM means too, right? What's that acronym stand for?
Sure, the Shared Appreciation Mortgage Program. So I'll start by saying a few years ago, we commissioned a housing supply study for our state. We were seeing that home prices were going up. We were serving the same dollar amount of production every year, but we were serving fewer families. And that was just showing us what the home prices were doing. And also rentals. We're hearing that, folks, there aren't enough rentals. There aren't enough for sale units. So we commissioned a study and we put a number to it. And we know that by the year 2029, we're going to be just shy of 300,000 units short in our state, both in home ownership and rentals. So we were thinking if we keep doing what we do every year, we're impacting it, but we're not going to put a dent in that $300,000 or 300,000 unit number. So, what can we do that would put new supply in our state, but also address affordability, because we are the state housing finance agency. We were created to help that low to moderate income Kentucky family. So, we can get the supply out there, but it's not going to do anything if the prices still are climbing. So that came to us in the form of the Shared Appreciation Mortgage Program.
I love it. I love it. So we're solving problems. That's what we're doing. We're solving problems, bringing new programs to the market, and making homes more affordable. Right?
Mm-hmm.
Absolutely. And Dan, I want to throw something in there. I want to say something about Kentucky Housing too, because we are very fortunate in the state of Kentucky. Now, Jamie, I'm going to brag on you and your team a little bit because you all are amazing. There's a lot of state programs. We do loans in a lot of different states, but here in Kentucky, we're fortunate to have a group that is actually responsive to what the real needs are of Kentuckians. And to actually proactively going out there and identifying to the point of what's the problem, and it's affordability, and why can't we have more people in the market, and to come up with real solutions to be able to solve a real problem for families that are trying to get out there and to buy their first home. And we're fortunate to have not just a team that are attentive to it, but are putting good practical solutions in place to be able to address those issues. So thank you, Jamie, for doing that.
Thanks, Brad. Your payment is on its way for that.
No payment.
Yeah.
Well, so let's just talk about. So, Sam, was it inspired by programs in other states, or is this something new that Kentucky built specifically for Kentucky families?
We modeled our program after California Housing Finance Agency. There's enough HFAs, what I'll say, we work similarly, but also differently. But what we do really well is we share good ideas. And so if we see somebody doing something that we like, we're not competing with them. So we'll call them up and say, hey, tell us about your program. So I'll give a shout out to Ellen Martin, who's the homeownership director for Cal HFA. California has the benefit of they've received just under $1 billion in state appropriations over the last few years for their program. We're standing this up on our own, but it's a great product. And we haven't even said what it is, but California is doing it. We know Michigan, Detroit is doing it. We know Utah, Colorado just announced one for their teachers. So it's out there. But it's more west of us. So we're thrilled to do this with our own money. to start with, but there is a plan for future funding needs for this program. But what it does is the shared appreciation mortgage program gives low to moderate income home buyers a 25% down second mortgage loan that can be used all to pay down on the principal of the purchase of their home, or most of it for principal, and also cover closing costs. But it sits as a silent second, so there's no interest, there's no monthly repayment. But what they do they do have to pay it back eventually, and when they pay it back, they pay back that original principal balance that they borrowed, and then whatever percentage of the original purchase transaction we have helped them with, that same percentage of the future appreciation they will pay back as well. If the home does not appreciate, they only owe us back that original principal balance. If the home depreciates, they just owe us that original principal balance.
So they're sharing a portion of the appreciation of the home, but in return, they're getting a sizable amount that they can utilize towards down payment and closing costs, so that we can make homes affordable and give people an opportunity to purchase that may not have had that opportunity before.
Exactly.
And so this is a form of a down payment assistance program. Is that correct?
Correct.
Yep.
And now Kentucky has more than one down payment assistance program. Is that also correct?
We do. We have an amortizing second mortgage, our regular down payment assistance, that's up to $12,500 to help with your minimal down payment and help with closing costs. That's repaid over 10 years at 4.75% interest.
So we're not replacing. This is an addition to.
Correct. I would say that folks who can get into the market now, the better option for them is to get into the market without the SAM program, because if you can afford to buy today, then you can realize 100% of that future appreciation.
Right.
But we are seeing nationally the age of a first-time home buyer is at a historic high, 40 years old nationally, and it's just getting worse. And the median price to purchase a home is just growing. So what we saw was, you're getting into your first job, you're thinking about buying a home, and maybe you're stuck between paying market rent, but you also can't afford this market. Or if you can find something that you can afford, it's going to need a lot of repairs or updates. And that's honestly where a lot of first-time home buyers struggle, when there's no landlord to call and you've got to replace an HVAC or you've got to replace a roof. So with our first round of funding, we are restricting it because we want to address supply. We're restricting it to newly constructed properties. So that should eliminate the high energy costs and the immediate repairs that have to come into the program for that first-time home buyer.
Understood. Now, Brad, let me ask you a question. From a lender's perspective, where do you see buyers getting stuck most often today? And I know you're primarily in Kentucky. Why do you think this program matters?
Oh, it matters a lot because it begins with affordability. It begins with the budget. I mean, it's all about the budget. When a family sits down, they look at their family, they look at the number of bedrooms they need, the number of bathrooms they need, where they need to have the home located, what area, what schools, all of that factors in. But then they have to turn around and they look at the reality of it. How much can I afford? And then, instead of getting a 2-bedroom or a 3-bedroom that fits their family needs, they have to settle for less. And sometimes they become discouraged. They try to rent. We know rent is just throwing money away. Sometimes it's necessary, obviously, but it's not an investment. It's not an investment in your future. It's not an appreciating asset that you would have. So we want home ownership and to help with the home ownership, but it all begins with the budget. And I'm excited because Jamie's got some showing some comparisons of payments. We were when they opened up the gates yesterday, we wanted to be the first, but there was somebody else that registered the first loan for this because we had, we've got borrowers that are excited about this because literally it lowered their payment buying a $200,000 home. So the loan amount was for $150,000. It lowered their payment by $400. That's a game changer. That's a car payment.
Yeah.
That's books for, that's school clothes, that's shoes,
2 weeks
that's
of daycare.
groceries. It's 2 weeks of daycare.
Yeah.
It's I can actually buy a home and feel comfortable and confident that I can afford to live here.
So if, it took a whole group of people that had become discouraged about getting into the home market and put possibility back into the conversation. And that's what just makes me very excited about that, because this is a practical program, because this program is partnering with borrowers to be able to buy a home. You know, Kentucky Housing has done that for years with partnering with the down payment assistance, the tax credits, all the different programs that they've had. But this is truly a partnership that they're going into that home, and you know, the person buying the home is full controlling interest in that property. But they're profiting. Oh, not profiting. They're partnering, and though they will profit from the appreciation of the home. So
But that, I'm sure that
that
goes back to funding more families and putting more people into homes, which is the whole
Exactly.
idea behind the program.
100%.
Right?
100%. To give hope for people that may not have had that hope there, just because of the affordability aspect of it.
Well, let's talk about this, Jamie. So, Sam, it's brand new. I think Brad let the cat out of the bag. Yesterday was kind of opening day, so to speak. And that's going to be my question. When did it officially launch? And can eligible buyers start using it today?
Yes, yes, and yes. We launched yesterday. We have 3 whole reservations. So we launched it with our own dollars. We had $10 million that we launched it with. And we're estimating if the median purchase price is around 250, then we might use 65. If we use 25% per loan, we think we'll be able to serve about 150, 160 properties for this first round of funding. But where it gets really exciting is we know there are local municipalities who see their housing supply gap as an impediment to their economic development. And they want to, you know, they may have the resources, they may want to do something with it, but they don't know what they can do. This is what they could do. They could partner with us and we could take their pool of funds and restrict it in our loan origination system, where if you were in Jefferson County, for example, and we had a pool of their funds, we could restrict it in the system so only the properties that meet Jefferson County's pool of funds would be eligible for you guys to reserve, and we can do that and track it, report it. And again, when those repayments come in, we're not doing this as a moneymaker, we're doing this as a mission purpose. So when those funds come back in, it's just going to recycle back out to other home buyers.
Well, I know we talked a little bit about this before, but I want to make sure that we identify this. So, and Brad, this may be a great question for you. If somebody's hearing about this for the first time, right, and maybe they think they can't buy a home or they've been reluctant because the affordability, how would you explain to them how this program works?
Before I answer that question, let me go back real quick on what Jamie was saying, because I think this is really important. If you're listening to this and you've got people that you know that may have influence in your communities, politicians, business owners, you know, factories, I mean, county officials, it is so important that a program like this, that what Jamie just said, that this is something that's applicable and scalable to each community in the state. And this is a program that will benefit if you this is something that you believe in, is home ownership. This is a way that you can directly impact your local communities on making that available. Because there's so many government programs, there's so many things that go out there, they're just throwing money away, and they're trying to create something that they hope works. Home ownership works. Home values go up in value.
That's right.
Taking the money, that investment in your communities, that you're investing in the people that are investing in the communities, so that there's a return on that. As the property value goes up, the homeowner wins and the community wins, and everybody a part of that does. So that's an exciting thing to be able to have that property. Okay. So how do I explain it to somebody who's sitting down with me?
The layman's terms. Yeah.
The layman's terms. You've got somebody that's going to partner with you. You know, and instead of you having to carry the weight on a full $200,000 mortgage, you have an opportunity to be able to partner with somebody to be able to, that they're going to pick up 25%, up to 25%. You can do whatever amount that you want, and you're carrying the rest. It's not that complicated. I mean, it's a very simple. We have a shared appreciation. We have AIM programs. There's a lot of other programs that are really, really good that aren't just limited to first-time home buyers, but they're pretty complicated. and it's hard to explain. This one's easy. You buy 75, they buy 25. You get 75% of the appreciation. They get 25% appreciation, and you pay.
You get 75% of the payment.
You get 75% of the payments.
Yeah.
And that frees up that money to be able to buy other things and to invest in other things for your family. So that's how I explain it.
When I first called Brad, we were talking, we have vetted this program as we've been building it. We did not want to build anything that, it's been 20 years, 24 years since I've taken a loan application. So it's like, we don't want to put something out there and then you guys are like, we can't do anything with this. Yeah. So we have put this in front of our lenders many times and we've said, poke the holes in it. We want this to be something that you guys can sell, that it brings value. And so Brad, I was surprised you didn't equate it, because when I first called you about it, you're like, well, that's like this bull I was going to buy. And I was worried that I had a buddy that was going to go in on it with me. And you equated it so beautifully that I got tickled at that. So I keep thinking about you buy 3/4 of the bull and we'll buy 1/4 of the bull. Yeah.
Yeah.
It's what's pressure.
I got my bull up here too. So
you do. And today we're going to give no bull. So
no bull.
But it's pressure tested, right? You've gone to the people that will be presenting the product, and you've asked for them to give their insight as to what's going to work and what's not going to work. And then you've put it down to a deliverable product that's actually going to help people purchase a home that other people can understand, right? And that's important. And what we're talking about understanding, I know you mentioned this earlier on, but how much assistance can the buyer receive? We know it's 25%. Is there a limitation to that? And then what all can those funds be utilized for?
So it's 25% of the purchase price. By statute, as a housing finance agency, we have a purchase price limit of $566,354. That by statute, that's as high as we can go on the purchase price of a home. But we can offer up to 25%. And that full 25% can be used for the principal down payment, or if you want to use 20% toward down payment and save 5% to cover your closing costs, if you don't have funds of your own to cover those closing costs, because that could be $10,000 to $15,000 right there. So, so you can use it for a combination of the two. We started with that 20% number because this goes with the Fannie or Freddie conventional first mortgage loan. So when you pay down 20%, you eliminate the need for that private mortgage insurance. So not only are you paying less per month just because you're having to pay interest on 80% of the purchase instead of 97% of the purchase, but you also don't have that additional fee of that private mortgage insurance. So again, it talks about affordability.
Well, and if I did my math right, what you're saying is that they're eligible for up to right over $141,000 for the right property, right? If they're going to purchase at the max property, that's no small potatoes, right? That's a massive investment, and this means they're not having to come out of pocket with that money, which gives them the ability to have more financial stability, or even invest their money or keep their money invested in other things that will grow with them along with the mortgage, right?
True.
So let's talk about this. What does the homeowner agree to in exchange for receiving the assistance? So we understand it's shared appreciation, but how does that look? What does that look like?
So we have a required, very specific, we partnered with eHome America to do a SAM specific home buyer education course that's available online. They have to complete that prior to the loan being approved. It goes into a lot of detail about that share of appreciation, how it's calculated, what that repayment looks like. We really want to be transparent and clear upfront with them on that course. And we modeled it after our California friends, but it's very detailed, and it's a lot of information, but you have to educate the person. And
they're taking an education course to really learn and understand what exactly, this looks like, what that investment's going to be, and how they're going to fare out at the end of the rainbow, right?
Make an educated decision. This is a good program, but there are pros and cons, and you need to make an educated decision. On top of that, we're also going to send an annual reminder to them. We'll be servicing those loans, and so annually they'll get a notice from us that reminds them, you've got this shared appreciation component. If you're curious about how much your home value is worth, here are the steps you would take to figure that out. And just, here's what you would need to do if you wanted to pay us off early, if you wanted to cap that appreciation and start to realize it fully on your own. So again, we don't want to hang out there and get big old repayments back. It would be great to roll it out to other people, but the point is to get someone in a home, and a success story would be that they sell it and purchase up, or they pay us off early and that money goes back into the pool for the next family.
That's fantastic. So just to understand, is Kentucky Housing becoming a co-owner of the property, or does the buyer remain in full control of their home?
They are in full control. I mean, it's their home. We have a second mortgage that goes on the property. We are certainly not on their deed as a co-owner. We're speaking in those terms, but no, we're not a co-owner. We just have a second mortgage. First mortgage will be on the property and a second mortgage specifically for the SAM.
Yeah, so it's no different than a bank holding a mortgage on a transaction, right? You still have full control over your property, what you do with it, how you do with it. But at the end of the day, you've got a lien that's held against it based upon the terms of the shared appreciation, correct?
Correct.
Yep. So Brad, I got to ask you this. When you first learned about SAM, what immediately stood out the most to you?
What immediately stood out the most?
Yeah.
Well,
Besides the cow story.
Well, I mean, it's the fact that, I mean, this is over and beyond we've got a lot of down payment assistance program in the state, and we have other programs that not are state bonded, you know what I'm saying, that are available to not just first time home buyers. You know, anybody who wants to get 100% loan, we can help facilitate that. Our mortgage revenue bond is already, I think, one of the very best. I mean, the rate's 5.75 with a down payment assistance.
It's huge.
15-year amortization, 4.75 on the second mortgage. That's strong. In this market, that's very, very strong. And as the market adjusts, Kentucky Housing will adjust to that as well. But even as good as that is, if this is a product that you know, because we're going to sit down with somebody and we're going to go through what the best fit is for that person, because this may not be, like Jamie was saying, this may not be the best way. You know, why trade off 25% of the future appreciation, okay, of your property if you don't have to? But sometimes it's a necessity to be able to facilitate owning the home that's going to serve your family the best. But even as good as the mortgage revenue bond program is, this program is really over the top with making that home affordable. You're talking about getting rid of the mortgage insurance, 25% of the payment. I mean,
We got the visual, Devin. Yeah, can you pull up
Devin,
that
can you pull that up there? I'd love for Jamie to share.
That's on my agenda.
To show that because that is a big deal. $400 is a lot of money on a $200,000 house.
We're going to pull that up. I do want to mention something though, because you know, again, we talk about who this is for, and you know, there's a lot of consumers that maybe feel like they're stuck in the rent race and they can't get out of that, and they look at buying a home and the payment's too much, or they don't have the down payment. But what they're not also looking at a lot of the times is that appreciation factor that we keep talking about, right? Like homes will typically appreciate 3.5 to 5.5%, depending on market per year, sometimes more, sometimes less, but it's there year after year. And effectively what we're talking about is if you stay in a rental property and you go to your, you know, whoever owns the property and says, hey, in 3 years, first off, for the next 3 years, I don't want you to raise my rent at all. Okay. And at the end of that 3 years, and I'm just using 3 years as the magic number, it can go on for longer, right? I want you to share 25% of the appreciation that you had in that property with me. Or in this case, 75% of that appreciation that you had in that property with me. We'll reverse it because it's rent. What do you think that landowner is going to tell you, right? No, we're going to raise rent every single year and you're not getting any appreciation for living in this property, right? Whereas the person who utilizes a program like this can now use the state's money to go out and purchase a property that's going to appreciate every single year, right? Year after year. If it doesn't, we have terms for that where they don't have to pay any type of an appreciation rate. And they're gaining equity for the first time in a lot of places ever, which is long-term financial wealth. And that's what makes programs like this one so impressive. So you guys talked about bringing the payments up. So let's talk about this and let's show people real time what that could look like. So here it is. Brad, I'm going to let you explain.
Well, actually, Jamie, if you want to, I mean, I'm sure happy to do that. But Jamie, if you'd like to go through that.
I can, and if you want to chime in, but this example is a $200,000 purchase price home, and it's important to note we do require taxes and insurance to be part of the house payment, but these numbers do not reflect that because taxes and insurance will be the same regardless of what loan type you are taking out. So this is just principal and interest payments, but That first column is a conventional first mortgage with a SAM second, paying 20% down and covering closing costs. So yeah, the purchase price is $200,000, but you're financing $160,000. And the principal and interest payment on that is $1,024. There is no second mortgage payment because it's that SAM structure. It's deferred until you repay it. So it's $1,024.50, not counting taxes and insurance, on a $200,000 purchase price. If we were to take that same purchase price and run it through the conventional product that is a 3% down with mortgage insurance, that principal and interest payment goes up to $1,541.84. And if we were to do it with an FHA loan where you're required to come up with 3.5% down, and you've got mortgage insurance, FHA's mortgage insurance on there, that's $1,331.69. So again, this program is limited to 80% area median income for this round of funding. So if you were, let's say, Hardin County, that is a $73,680 annual income. If you're below that, you can choose between the $1,000 payment or the $1,500 payment or the $1,300 payment.
And I'll just pop that up there just for comparison factor. We have a few other 250K option, a 300K, and a 400K. Just to put things into relation as to how that would look utilizing the SAM DPA program. So this is huge. Brad, anything you want to point out while I've got the slide pulled up?
Well, I mean, the numbers say it all. I mean, and actually I was wrong. It's not $400, it's $500 difference. So it's it's a game changer. It is an absolute game changer for the people that qualify for it. Is it for everybody? Not necessarily. I mean, because you got to be below that median income. It's got to be a first-time home buyer. It's got to be a new construction, which I think is another brilliant aspect of it because it's helping people in Kentucky. It's helping builders in Kentucky and manufactured home dealerships in Kentucky to be able to move their inventory because it's all important part of the process. If the builders aren't healthy or the manufactured home dealerships aren't healthy, then they're not able to scale up as the affordability changes to be able to get more homes out there. It's all a very important part of this process. Each one of us plays a role. Jamie plays a role with the Kentucky Housing. We play a role as lenders. The builders play a role. The buyers play a role. It's all a part of a community. And working in unison, we have to get creative and on taking the hand that we're dealt, the economy that's there, the inflation that we have, the diesel costs that we have, the building costs that we have. It all factors in together. And the ultimate goal is how do we put people in homes that they can not only just buy, but they can afford to keep and to be able to have a successful life and to create memories in that home and an appreciating value. So it all works together.
And we didn't talk about the property types because it has to be newly constructed, but that can be site-built home, manufactured homes. It could be condos. It can be owner-occupied duplexes where you live in one side and rent out the other, or you got a family member that lives on the other side. So, Brad and the loan officers who are participating in this program, when you go to find a loan officer, not every KHC loan officer can do this. So they had to complete a specific training and they had to sign an addendum before they could offer it. We have roughly 40 in the state that can do it. When you go to our website and find a lender, of course, you got Brad right here, I will say, but there's a tab specifically for the shared appreciation mortgage program that has all the companies that are working with this.
Well, and you mentioned a mortgage hack right there. I want to throw that out there. You talked about a 2-unit where you live in one and occupy one side of the property, right? And then you have somebody else that lives and occupies in the other part of the property. So let's combine those two things together. Now you've got a shared appreciation mortgage where 25% of the home is being paid for by the state of Kentucky. Now, of course, there is a appreciation at the share at the end, but you put somebody next door and you have them cover a portion, if not the entire payment, allowing for you to either live partially rent-free or completely rent-free while gaining equity through the shared appreciation mortgage. So the savvy buyer, there's a lot of, I know we're not supposed to talk about investors today, but there's a lot of investors out there, right, that use this to start acquiring wealth and acquiring properties where they have somebody else paying that rent. So, I just want to point that out, that if you're really thinking about this and you're in a position where you could do a multi-unit, wow.
Owner
Oh, yeah,
occupied, they have to live in it, so they're not. Yeah.
Well, 100%. That's
Yes.
you live in one and then you lease out the other, right?
But every homeowner has to assume an investor mindset. You want to begin with the end in mind. How is that the investment that you're making? Yes, it's serving your family needs, but also how is it going to appreciate? And when you go to sell that property, move on to your next home, or whatever your next step is, you're treating that as an investment, because it is an investment.
That's right.
And for most folks, that's your most important investment that you're making is in your home. So I love that you brought that up about the duplexes, because it is absolutely brilliant.
It truly is. It's a mortgage hack. It's something I talk about on my channel, all the time. How can you build wealth or equity, utilizing somebody else's money, right?
We just opened that up back like in last winter again because of supply. Like we can't restrict, if we by statute can do an owner occupied duplex and we know that there is a supply issue, then we don't need to have any obstacles. So
you have to occupy, and we want to make sure that we make that very present here. You have to intend to occupy one of those units to be able to utilize the program. So,
yes.
What are the biggest misconceptions that people have about a shared appreciation mortgage? Because I know there are misconceptions there.
Can I answer that?
Please.
People, when the first knee-jerk reaction when they hear about this program or any kind of a shared equity program, is that they're giving something up. You're really not.
It's predatory.
It's predatory. It's an investment, and really, this program and programs like this is the only way. Because when you go to buy a home, the only things that you can do to make that home more affordable is that you put more money down. Well, if you don't have more money to put down, well, that's not an option. You make more money. Well, that's great, but you got to talk to your boss or your wife about that. And are you going? So if those two aren't an option, what do you have left? The equity in your home. Well, what equity do you have when you're buying a home? Not anything yet, but you know that you're going to have future equity. History proves that to us, that you're going to have the equity there. These programs allow you to take future equity.
That's right.
To be able to invest that in your monthly mortgage payment now. Okay, so you're not giving up. What you're doing is it's facilitating being able to take future equity to spend it now for when you need it.
Let's talk about it. I love that you said that, Brad. And for those of you that are watching on the mobile site, you can probably see I've got a Back to the Future time machine over here, right? So essentially what Brad just said is that you can take this time machine into the future, and you can say, hey, future self, I want to borrow money from the mortgage that you have now. And then you travel back in time and you utilize that money as the down payment to purchase the home that you're going to be building equity in the future. And that's really what's happening here, is you're taking your future equity to purchase the home so that you can make an investment and make the home more affordable for yourself right now.
Yeah.
We got a good question. Sorry,
go
we're just going to go to Troy here. And he says, how does it work if you're self-employed? And Brad, I think that's a question for you, because we know you can do it, but how does it work, right?
No, it's all the same thing. We would calculate the income just the same as we always would. Self-employed borrowers have a few more hoops to jump through than if you're just a W-2. It's not hard. We just have to go by what's on your tax returns. We average in 2 years, and that all, it's the same for every lender. We go through the same hoops. We have to check the same boxes on that. It's all what's in black and white on that. But that's a great opportunity to be able to sit down and let's go through the tax returns and see what the affordability is there as well. And
I think you say it's the same for every lender, and technically you're right, Brad, but the right lender is going to make sure that they cross their T's and dot their I's when they analyze that income, and the wrong lender can definitely underperform. So if you've been 100% that you don't qualify with self-employed income, perhaps that's accurate, right? I don't know. I'm not looking at your personal situation, but A lot of the times that's not 100% accurate. It's because the person that analyzed your income didn't understand it. And even if they don't put you in a position to be able to qualify today, a great lender can help you identify what you need to do in your future tax filings, so that you can potentially qualify in the future. So don't count yourself out just yet, right? If you do have want some information on that, we're going to be popping up a QR code at the end of the podcast. So stay to the end, and you can get more information on the program, as well as have direct access to Brad, who I can assure you is one of the better LOs, one of the best LOs in the industry. That's why we've chosen to represent him here on the show today. So
I want to throw most of the time what happens is, because we all lenders have the same guidelines and criteria. Now some lenders will have overlays. Plug for Kentucky Housing, they go by agency guidelines. We can talk about that more later, different podcasts, but that's very important.
It is.
But the most important thing, that what separates loan officers from the exceptional from the just participants, is not just knowing to answer the questions, but make sure they're asking the right question.
Amen.
Because if you ask the wrong question, you'll always get the wrong answer. And it's starting with the right questions to where, and every person is different. Every need is different. Every family is different. And you have to be able to ask the questions that's going to be able to customize the loan.
Uh-oh. We were on a great train of thought. Well, Brad, we lost you a little bit there, but let's go ahead. We're kind of running a little over on our original planned time. So, Jamie, I'm going to ask you some questions, and let's kind of fire through these pretty quick. So, I know you mentioned before, but how much funding was committed for the initial rollout?
$10 million.
10 million. And as of today, are there still funds available?
We have whopping 3 loans locked, but yes, there are still funds available. I think it will pick up steam, but yes.
And at what point is the funding actually reserved for the buyer?
Lenders will lock that up front. We hold it and we do a 75-day lock, and lenders can extend that if needed, but they are holding it like as soon as you sign a contract. You should talk to your lender first and be pre-qualified. Keep them in the loop as early as possible and throughout the process, so that as soon as you've got that contract, they can go in and lock those funds.
And if I hear you correct, you said 75 days, which typically a loan doesn't take 75 days to close and transact. However, we're doing new construction, so we're giving ourselves more time for the builder to complete that project. Is that correct?
Correct. Yeah. Our 3 loans that are locked so far are all newly constructed, so they were already, that agency definition usually is up to 12 months old and unoccupied. So that's where we're seeing that go initially, and we thought, well, are we adding to supply at that point or are we not? But the thought is, if that builder is sitting on that property and can't unload it, then we can help take that off their hands, and then maybe that would entice them to build another property.
It's fantastic. What happens if somebody qualifies after the first round of funding?
After the funding's gone?
After it's exhausted.
Well, we hope that we don't. We're going to exhaust it. This money will go quickly, but we're hoping that we can have those partnerships with the local municipalities, and we're looking for other ways to fundraise to keep this going, because we really see this as a viable option. We can't do anything to lower the cost to build a home. We're not within our power, and we don't have this just unlimited supply of money that we could just give away and not get it back in some form to reuse it. So this is the best option that we came up with. We're also hoping to be able to demonstrate a working model, a successful model that we can take to our state legislators and say, hey, we all know there's a supply crisis. You guys know it as well. Here's a plug and play. We're ready to do this, and this works. We just need some money.
Yeah.
I love it.
Brad, Jamie, can you share with who they need to reach out to for somebody that's listening that wants to just reach out to you at the state, or to who would they talk to about setting up something for their community?
Sure. It's been myself, but Heather Hairgrove is also we don't have it on here, but it's Heather H. Hairgrove, HAIRGROVE at kyhousing.org.
And I just put up, so the website is kyhousing.org, kyhousing.org. And if you're watching, you can see it running across the bottom of the screen. You should be able to find all your contacts there, get phone numbers. So if you want to reach out to somebody there, you can. And, Brad, you represent New Beginnings Mortgage. So if you want a lender that can help you answer some questions, Brad is certainly qualified. You can find Brad over at beginmtg.com. That's beginmtg.com. That's running across the bottom of the screen as well. And then you can also find Brad on Facebook at brad.chambliss1. That's brad.chambliss1. He'll be the gentleman with the cattle as the backdrop, because he's a cattle farmer as well. And then you can also find Kentucky Housing on IG at KY Housing. And then we're going to throw up a QR code at the end. So if you do want more information, you want some of the slides that we have here, you just want to understand a little bit more about the program, you can scan that and you can learn as much as you want, and just get started, right? Just get started becoming a homeowner, which I think is really, really, really exciting stuff. So let's do this. Jamie, what would success look like 1 year from now?
We have blown through this initial 10 million, and we have lots of partners who have set up restricted funds, and we've got unrestricted funds from the state, and we are just putting lots of new units in. We're adding to the homeownership supply in our state.
I love it. Brad, biggest mistake buyers make before talking with a lender?
Selling themselves short. Not really exploring all the possibilities that are there. I mean, and learn what the questions that they need to ask. Lenders need to ask the right questions. Buyers need to ask the right questions. And so it's when somebody comes to our office and we sit down with them to go through their application, we never say no. It may be a later, but it's never a no, because we're going to give you a game plan on what to do. If you do this, this, and this, you're going to be a homeowner. Okay. So we don't want you to get discouraged. Rome wasn't built in a day. Sometimes it takes time. That doesn't mean that it's not worth it, because it is worth it. It's worth the effort to be able to put yourself in a position. This program starts off a 660 credit score is what you need. Not everybody has a 660 credit score to be able to qualify. So it's what do we have to do to be able to do this? Maybe it's not on this wave of funds, but preparing yourself to be ready when that opportunity is there. And what do you have to do to get ready to be able to buy a home? That's important.
You know what I see, Brad, is I see you at your conference table with a big piece of map out, right? And you're literally drafting out this map to home ownership right there with your clients, so that they know exactly what they need to do to get to the treasure right at the end, and that's home ownership. I'm going to call you Captain Brad Chambliss. Just here to navigate you to home ownership using this amazing program that Kentucky Housing has brought to consumers. So, Jamie, closing question for a Kentucky family watching today who believes home ownership is out of reach. What do you want them to understand about this opportunity?
It's new for us. It's innovative. It's different, but all good things. But we really want them to make sure that they take the course, they educate themselves, they understand exactly how this works, and then if they determine that this is the path for them, find a good lender. And I will say we work with some of the best lenders in the country, and we've got great lenders, and they're there available. Brad is here as an example. Work with a great lender and get into that home. If you're not able to do it today, they will give you, not today, but here's what you need to do.
Amen. Brad, what is the first step someone should take if they want to find out whether Sam is going to be the right fit for them?
Just call us. Reach out to us. Start a conversation.
That sounds way too easy.
And that's it.
Sounds way. Well, guys, as I mentioned earlier today, and Brad, you just said it, just reach out. If you want to reach out to Brad, or if you just want to get some more information on this program, if you scan this QR code, it's going to take you to a quick survey, just ask you a couple of quick questions, and it will immediately send you a PDF of all the information you need to know about Sam. So guys, thank you so much for joining in today. We appreciate having you here. Jamie Rice, thank you for representing the state of Kentucky and bringing this amazing product to market. Brad, brother, as always, great to see you. And I think that's it. Till the next time. We will see you guys then. Take care, everybody.
See you guys.
Bye.